We are starting the recording. This is going to be a pretty quick presentation unless there's questions. But my goal is twofold for this. The first goal is to give you a quick update on rates and what's going on with rates. Obviously, there's a lot of news about rates these days and inflation. So I'm going to give a quick update on that, how it's filtering into the mortgage market. And then the second goal is what I'm saying down here is, do you have a deal? And I'm approaching that two different ways. I'm approaching that from you as a buyer's agent, talking to prospective buyers that you will represent as a buyer's agent. And then I'm also want to touch on that as a listing agent. When you get offers and you're scrubbing them, you're looking through them, you're looking through the pre-approvals, you're looking through the FICOs, you're looking through the findings, the DU findings, you're looking through, or you're calling the loan officer. At the end of this slide, I have a slide specifically geared towards 10 questions that you can have in your Rolodex, that when you have 5 offers and you're trying to pick the best one with your seller, you can call the loan officer and ask them these questions, and it will give you a good, rather in-depth analysis of the loan, just to make sure that this guy or girl that's doing the loan for the buyer side, should you need a loan on that deal, knows what they're talking about, knows what they're doing, has a good idea of their own file. You can catch them a little bit with these questions, and then you can come back and bring them to me with your answers, and I can say, yes, this is sound, or no, this is bad, or this is not good, or don't do this one, or, you know, try to help you stack in order the offers that you get from a lending perspective. This came to me because Fritz in our office is teaching new agents about the business, and I feel like this is a very important part of the business. So that's why I wanted to do this class. So next slide, please. Okay, just to reiterate, save this, print this. This is the current loan amounts for all of the 4 counties that are around us. San Bernardino is the same as Riverside. Loan amounts went up the latter part of last year. The top number, if there's 2, is the conforming limit. The second number, if there's 2, is what's called the high balance conforming limit. Orange County, Los Angeles County, Ventura County have a second tier that they allow conforming loans to go to. The real point and the real important piece is the down payment restrictions to those second amounts in those counties is only 5%. So you can buy a house for $1 million in Orange County with 5% down. Okay, you can buy a 2-unit house in Orange County for 1.3. That actually requires 15% down. Sorry, but basically it lets you do less restrictive loans to higher loan amounts in those higher cost counties. This is why this is important. You don't need to memorize these, but just have an idea of conforming versus high balance conforming, and know these loan limits. Next slide. Okay, where we're at today. Over the last month and a half, since the beginning of the year to now, we have seen interest rates rise roughly 1%, which is pretty unprecedented. It hasn't happened in my tenure, which I've been working in this job for about 12 years, that type of increase. So it's still really good rates though. And that's the point that I want you guys to stress is, yes, they've gone up, but historically speaking, if you were offering someone 3.75% on an interest rate, they'd be doing backflips. So put everything in perspective. Yes, we've seen a rise. Yes, it's raised prices, or yes, it's raised payments. Use this as a little bit of impetus for people to get off the fence, I would say. But this is where we're at. Conventional loans, 3.75. Conventional 15-year loans, 2.75. FHA and VA are still really good. Those are the government-backed loans, 3% on those things for 30 years. Jumbo rates you can see are pretty low, to be honest. Jumbo loans in Orange County would be anything over that 970 loan amount for single family homes, those are around 3.5%. A 7 year is an adjustable loan where it's fixed for 7 years and then adjusts for the next 23. Those are 3%. The most important headline, the most important thing that's affecting interest rates for mortgages right now is inflation. The cost of everything has gone up a lot. The cost of goods, the cost of gas, the cost of homes, the cost of you name it, it's gone up. They think it's because of some supply side issues, the boats off our coast, that's causing inflation. They think it's because people have a lot of money from what the government gave them, so they're willing to pay a little bit extra because they have an influx of money from those blessings from the government. So there are some things that think it will settle down. January was not settled down. January was the highest reading of inflation in 40 years. So your money isn't going as far. Things are more expensive. To curb that, the Federal Reserve increases what's called the federal funds rate. The federal funds rate is not the same as mortgage rates. Please remember that. I've said that a number of times, but they go hand in hand. They're kind of tied together. If the bank has to spend more money to get things, they're going to raise their interest rates that they're offering people for mortgages to make more money. Okay, so if the Federal Reserve comes out in March, which is the next meeting, and says we're going to raise the federal funds rate, mortgage rates will go hand in hand and they'll go up again. The current expected increase is about 0.25% in March. That's already built into mortgage rates. So in March, I don't expect mortgage interest rates to go up too dramatically. It's already built in. But if the Federal Reserve comes out and raises them 0.5% or 0.75%, then you will see mortgage rates go up and coincide with that increase. So be on the lookout. It's again, the meeting's in March that the Federal Reserve will speak. I don't know the exact date, but I can email that to you guys if you ask. One thing I wanted to point out, again, I was just on, this is based on about a $600,000 loan amount. That 1% interest rate increase is roughly $400 a month. So your client's payment in December was $400 a month cheaper than it is right now for a $600,000 loan. About $450 for an $800,000 loan, about $550,000 or $550 for a $1 million loan. So, you know, not pennies. Use that info if you'd like. You know, this is based on people's credit score. It's based on down payments. Each person's situation is different. So don't put that up on a post without having the right disclaimers. You know, I want to encourage you to do that. But it definitely is something that when you're talking to people out at, you know, coffee or you know, cocktails or something, you can use those rough numbers for yourself. So that's where we're at on the current market. Again, be on the lookout for March. Rates are rising. They have to rise. They've been so low for so long that they're going to continue to go up. How far from here, I don't know. Usually they go up a lot quicker than they go down. They've gone up a whole percentage point. So I would bet that they're going to stabilize a bit right around here. But it's just dependent if Russia and Ukraine get into a war, rates are going to probably come back down a little bit. Rates on mortgages are really macroeconomic based. Big events in the world, if they're negative, if they're bad, that's when you see interest rates get better. If the news headlines are good and people are throwing all their money in stocks and, you know, economies are coming back, that's when you see mortgage rates go up. So that's your little status update. Great, next slide, thanks. Okay, so this slide is your keys to your buyers, right? So you get a call from a client or you get a referral from a client and he or she is a buyer. The three pieces of them getting a loan are their income, their credit, and their down payment. I obviously will vet your clients to the nth degree on all of this information, but your time is very valuable. And when you get a call from a buyer, I want you to have a little bit of, some loan info in your back pocket to vet them, to scrub them, so that hey, this person is telling me the truth, or this person probably can't get a loan and I need to move on and use my time elsewhere, right? Where do you want to live? What kind of house do you want to buy? How many bedrooms, etc.? You guys do all of that, great. But you also need to just find out a little bit about their finance side, I think. I'm happy to call them regardless of if they have a job or not. I'm happy to call them if they say they don't have any credit, because we can help them. We can get a mortgage plan going. We can do a number of things to get them into our Rolodex as clients. But I think from your time perspective, it's important to ask a series of these questions. This is on the buyer side for your own representation as a buyer's agent. Hey, what do you do for work? Are you hourly? Are you self-employed? That's a simple question. Do you make commission? Do you make overtime? Commission and overtime are important because I need to have them for 2 years. And then length of time on the job. Have you been on your job for 2 years? If you haven't been on your job for 2 years, were you going to school before that? If there's a logical reason, were you pregnant and had a baby before that? If you can explain why they haven't been working for 2 years and they just got a new job, we can do a loan for them. If they, were just traveling, then maybe they need to be on their job for about 6 months before we can get them a loan. So length of a job is important. How they're paid is very important in terms of how I will do the loan for them and how I will calculate their income. Okay. Ask you about credit. Credit is, as equal to importance as income is, right? Credit scores are very, very important. You have to have credit to buy a house. If they don't have credit, they can go and get on a card with their mom and dad or their sister or their brother as a joint, borrower on that. And then they can come back and we can do a loan for them in 2 to 4 months if it's a lower loan amount. But if they don't, we need to get them some credit. Most people these days will have a Citi card or a Capital One card or a Wells Fargo card that will be able to tell them what their credit score is roughly. That score is going to be higher 99 out of 100 times than what my score is, because it's not for a mortgage. Mortgage credit pulls are the most strict credit pulls there are. So if they tell you their credit from their Capital One card app is 720, most likely mine's going to come in around 700, 710. But if they tell you their score on their app is 610 or 600 or 580, then I'm probably going to get something lower than that. Okay. So just be aware of that. Asking them about credit lets you ask them about other events. Like, have they owned a house before? If they've owned a house before, what happened to that house? Did it short sell? Did it foreclose? Did they sell it for a profit? You want to know about someone's past history as a homeowner if they were a homeowner for this future. It really, really matters for my side of things. And it lets you gauge what type of home experience they had the first time, how sensitive you need to be to this situation with them. Okay, so that's what derogatory events is: foreclosure, short sale, deed in lieu, a number of those things. You can ask about that. Down payment. You have to have down payment to buy a house. Okay, you guys do not want to be seeking clients that don't have down payment. Okay, it's just not a good thing for you guys to do. It's a waste of your time, in my opinion. There are loans out there that get done with grants and get done with other types of gifting for down payment, or they can borrow to 100%. But I just don't see those offers getting accepted. I don't see that as a valuable use of your time. Someone needs probably 20 grand to buy a house. Okay, having that as your number in your head is a really good number. That's a 3 to 3.5% down payment on a $400,000 place, plus some closing costs. If you guys think you can get some closing costs from sellers these days, go for it. I think 20 grand is a really good number. That's what I use on my end when I'm telling someone that just asked me, hey, how much money do I need for a house? I say 20 grand. Okay, use it if you want. Down payments can come from checking and savings. Down payments can come from stocks. A lot of these new tech age employees are getting stock benefits when they're getting employed by those companies. They can sell those and they can roll that money into their checking and savings account and use that as their down payment. Okay, so if someone doesn't have 20 grand in their checking and savings, ask them about their stocks. Ask them if they have a 401k from their company. They can borrow from those 401ks. If none of that exists, ask them if they can get a gift from a family member. Okay, there's alternative ways. Don't just throw the deal out because they say they don't have any money. Let's try to come up with another way to find that money. And again, this is all stuff that I go through with them, but this is a way for you to put different buyers at the top of the list. If you have 12 leads and you're going through them, use this to allocate, the numbers to those people, whether they're, high potential of getting a loan or low potential of getting a loan, and allocate your efforts to the people that have a good job and have a credit score that you think is pretty sound and have some down payment. Okay. No questions on, is Alex? Yes. Yeah. I'm one that sits in the office, Mon.
He's right up at the front. Go ahead.
Yeah, go ahead. So these are some other tips that I want you to think about when someone gives you an answer. There's always, you have those questions that I just gave you on the last slide, but then if someone gives you an answer, you don't know what to then do with it. So someone says, yeah, I make $30,000 a year. $30,000 a year is probably not enough money right now to buy a $400,000 house. What would they need to do? Hey, would your mom and dad be willing to sign? Would your brother be willing to co-sign? Could you buy the house with a friend of yours who wants to live with you, and then you could do the loan with both of those people? That's adding a co-signer. Okay. Someone cannot just go out and get a second job. If you have a second job, you have to have that second job for 2 years. Okay. So if they tell you, hey, I'll just go get a second job to get more income, that won't work. And you could just nip it right there. So if they've had 2 jobs for 2 years, if they're working at a restaurant and valet parking for 2 years, and we can use those. If they do the same job at 2 different locations, we can use that, but it needs to be for 2 years. Let's say they tell you, oh, my credit score is really low. Obviously, I would say move on, but we can get these people into a mortgage plan. One of those plans that I have is I work with a company that can increase their credit scores. They work with the derogatories on their credit score. They send letters out to all the companies that are having derogatories on their credit and say, hey, prove that this is my client. If it's not, you have to take it off. It's not an overnight process in any way, but it's a way for you to fill your pipeline. And the companies that run credit repair are notoriously shady, right? For a lack of a better word. They're not good companies. This one that I've found is probably a B plus or a B if I would give them a grade. That's much better than most of them, which are D's and F's in my experience. So keep that in mind. We can, get them in, I can talk to them, and we can get them into a repair program after I take a look at their credit. The number one way for you to recommend someone increase their credit is to lower the balances versus the limits of their credit cards. That's honestly the number one way. Their late payments, if they were responsible for them, are not going to go away. But if they have $5,000 out on their Capital One card against a $5,000 limit, that's why their score is pretty low. You can drop that down to 1,000 or 2,000, probably going to see a pretty significant increase in their credit score. And you can use that. The number one question that you probably get is, does running my credit score hurt my credit? And the answer I typically give there is that after 2008, when all of the mortgage stuff melted down, they came out with new rules, and new rules include the credit score running of a client. Typically, when you're shopping for a car, or you're shopping for a mortgage, you have about 30 days to be able to go and shop against different companies. Okay, you can shop me, you can shop Bank of America. That's only going to be one credit run against you. Will it drop your score 50 points? No. Will it drop your score 2 points? Maybe. If you have a bankruptcy and you have a high balance on your credit card, and then you're going and trying to get another credit card and another auto loan, and all the different types of credit, that's where you're going to start to see your score get hit pretty hard. But if it's just some mortgage guy running your credit, it's not going to sink your score 50 points. And that, I can guarantee that. So use that, because me running someone's credit and you knowing their credit score is very important for you knowing if you have a viable deal. Don't drive people around on the weekends if you don't know what their credit score is, just because they told you what their credit score is. It's not worth your time, in my opinion. Okay? If you know this person maybe from history and they got good grades in school and they always pay their bills on time, maybe do it. But if it's just some random client, I wouldn't. Okay, and I wouldn't let them tell you that their score is good. Just let me run it. It's $20 and I cover it. Okay. Down payments, again, if people are saying, yeah, I just don't have that much savings, it doesn't really take that much to buy a house, right? 3% down, 12 grand on a $400,000 house, on a $400,000 condo. Okay. It's just, I feel like someone can get that money. You know, people are working, people are making good money. I feel like that's out there. So 3.5% on FHA is not much more than that 12 grand. You know, it's just over 13 grand for that. So know those like the back of your hand, to be able to combat these buyers if you're vetting them. If they say, oh, I don't have any money, well, it doesn't really take that much. What kind of money do you have? You know, keep the questions flowing. Keep the questions flowing. Always ask them if they were in the service. VA loans don't take any down payment. They do need some closing costs, but sometimes you're able to negotiate those, or I can use the interest rate to cover some closing costs on both FHA and VA. Okay, so 20 grand, great number. 12 grand, 15 grand, we can work with. Okay, so just keep those in mind. This is all I have for buyer tips. I'm going to start working with Fritz, who is in our office and teaches I don't know, what is that called? Alia, his class?
Just coaching session with
Session with Fritz, where we can go through situations. We can run mock situations with buyers. We can even get on the phone with one of your buyers on Fritz's class and give them a call. And I can show you how I qualify them. I'd love to do that. I'm going to segue now from a listing perspective. The questions are going to be relatively similar to this that I just gave you on the buyer side, with just a few more additional. But there's 10 questions that I would recommend all of you agents do when you get offers in and you're able to look through them. 10 questions here on the next slide that I also have printed out at the office that you can keep, and we'll be able to email these to you as well, that you should ask the loan officers. And it's very, very important for you to establish how solid the buyer is. And I think you can get a lot of info from how solid the buyer is by talking to their loan officer and seeing how much of their deal they have in their head, how prepared they are. That will tell you a lot about how that deal is going to go, in my opinion. Next slide. So, hey, this is what you would call and ask that loan officer. What do your clients do for work? Similar to what you did on your buyer tips. How long have they been doing it? Self-employed. If the buyer is self-employed, we really need to have a little bit better in-depth look into their income. Okay. Self-employed isn't as strict now as it was when the pandemic was happening. The rules for conventional and FHA loans have now been laxed for self-employed people. We don't have to show profit and loss statements anymore. We don't have to show business bank statements anymore, but they're still going to scrutinize these people's income for 2 years. They're not just going to look at it for 1 year. 1 year is very, very slim probability. So you want to have someone self-employed for multiple years. What are their credit scores? Again, very, very important. I would, when you do your MLS listing, I would ask for credit scores. I would ask for proof of down payment. You guys all do. Potentially ask for the desktop underwriting findings or the loan prospector findings from the Freddie Mac. You want to have those, and I can read through those with you, okay? But just quickly knowing what their credit scores are is going to be helpful. How much down payment are they intending to use? The next one is very important. Where's the down payment coming from? People like to show you someone's account, and then all of a sudden the down payment comes from somewhere else. I know it happens. I've done it before, okay? So you really want to vet where that down payment is coming from. Is it coming from a gift? If it's coming from a friend, you can't get a gift from a friend. Okay, you can get a gift from a family member. You can't get a gift from your fiance's mother. Okay, you can get a gift from your mother. You can get a gift from your wife's mother. But there's certain little idiosyncrasies with who the gift can come from for how this would work. So make sure that you ask that question if they're showing you a different person's bank account as the source of the down payment. Okay, you want to make sure that if their credit score is low, if they've had any bad if they've had any foreclosures, short sales, any sort of derogatory events again. Do they own any other properties? This one's very important, I think. If the buyer is buying your house and they own another property, what's happening to that house? The lender needs to know that right off the top of their head. They need to be able to answer that question right away. Are they going to rent it? Are they going to sell it? Do they need to qualify with the payment on that house plus the payment on my house? You need to know that. That requires someone to have a lot more income if they're now floating 2 mortgage payments, 2 property taxes, 2 insurances, okay? What are your underwriting turn times, right? If someone writes you an offer for 21 days, but there's 7 days in initial underwriting, that deal is not going to get done in 21 days, okay? If initial underwriting turn times are 2 days and they write you a 21-day offer, you have a much better shot. Underwriting turn times are the length of time that it takes a bank to receive, review, and give you a loan approval on the buyer's deal. Okay, that comes out to an approval, and then the clients and the loan officer have to work through that approval. Hey, what's this deposit? Hey, where is your money if you're going to liquidate stocks, etc. But that initial approval is what a lot of people in my shoes use to then come back and be able to release that loan contingency, okay? So you want to know that turn time and tie it together with the contingency. Is your underwriting turn time 7 days and they wrote a loan contingency of 10 days? It's probably pretty tight. Same thing with the next question. If your appraisal turn time is 12 days, that is the one probably bottleneck of deals at the moment is appraisals are taking a little bit longer. Not as much now because rates are up, but they still are taking a little bit longer. So if someone's writing a 7-day appraisal contingency, they need to order that appraisal on day 1. And you need to tell them that as a listing agent, because that's your job for helping your seller. So find this out and then tie it all together. Make sure it all makes sense. Make sure the calendar makes sense. That's the whole goal with those last 3 questions. Table funding. What is table funding? Table funding is the bank doesn't need the docs actually physically in their possession. They can go off of scan docs and they'll literally send the funds for the loan right away, right when the loan is set to fund. It's important because what I find is deals always take till the end. For some reason, if you write a 30-day transaction, my deal is going to close on day 30, not on day 29, not on day 22, not on day, just for some reason, it just takes to that point. So you want the fastest possible funding process in your favor. That's table funding, okay? If the bank requires the docs back and takes 3 extra days to fund the loan, then you could go over your escrow time, and that would not be good for you as a listing agent for your seller. So find these out. Go over them with me, go over them with your in-house lender if you're up in LA. Let us help you pick the right buyer for your listing if you need us. We're there for that. We're not just trying to do your loans. We're trying to help you on all aspects of your job, okay? That's why I'm here. That's why, again, the other loan officers are there in your office. We can help you with this element. We can review the offers with you when you're a listing agent. We can help you with your buyers. Obviously, that's number one for us because that's where we get paid. But from a value add perspective, we are here to help you run your business and do what's right by both buyers and sellers. And this should help you do that. There's this, I have this in a piece of paper that I can email to you just so you have it. You can print it out, write it down and ask them. If there's any other questions that you think should go in there, add them. This was done pretty quickly by me this morning, but this is, I think, a really good initial picture of your buyer's deal when you list the house. And this should give you a good idea if they're going to close the deal or not, the answers to these questions. And I think that is it for me today. There's my email, there's my cell, missing.com on the email.
All right.
Again, I'm in the coastal office. My name is Alex. I work with NAL Financial. We are a mortgage broker based out of Newport Beach and Long Beach. And we're always available weekends, texting, evenings, whatever we can do to help you. Hope you saw some value in this. Please let me know how I can help.
Thank you, Alex.
Thank you.
You're welcome, Cal.
All right,
I'm
take
gonna
care.
put Alex's information in the chat as well, in case anybody just wanted to copy and paste.
Thank you.
Hopefully these rates settle down for you guys, for me too. Holy cow. Thanks for coming, Cal. I really, really appreciate it.
Yeah, thank you. It's always very informative, educational, and I'm all about the education. Hey, do you have time for a super quick question?
I do, yeah.
Yeah. Hey, I thought I saw somewhere maybe on your social media that there was a change where in the past, a co-signer had to be somebody who was going to live in the property, but that wasn't true anymore.
Yeah, you can always do non-occupant co-signers.
Okay.
So right now I'm doing a deal where the son is going to move into the house and his mom is co-signing and she has her own house. She's going to stay there, but they just qualify against the mom's payment on her house as well. She makes enough income to where the difference of her income and her mortgage still benefits and helps the deal.
Mm-hmm.
But you do not have to occupy to be a co-signer
Okay.
at all. Yeah,
Cool.
there's certain loans that restrict who can be a co-signer. There's certain loans that allow co-signers, but those are more in the $1 million, $2 million, those upper end loans. All the stuff that's in LA County below $970,000, essentially anyone can be a co-signer. Your friend can co-sign for you. My business partner could co-sign for me. They just are liable for the deal, right?
Yeah.
If you don't pay your deal, it hits their credit. So they got to know the risk going into it.
Just like a car.
Just like a car. Yeah, this one's mortgage is more,
Fun,
it
right?
affects your credit a lot harder than a car does. But yeah, definitely doesn't need to be occupied.
And then I don't know if you actually said specifically, but about how much does you running somebody's credit report affect their score?
A couple points, if any.
Okay, that's what I thought. It's,
Yeah.
You try to tell people that and they don't believe you.
They don't. No, the literature and the news that is out on it will say otherwise, but it really does not affect their credit score. And I'm able to talk them through that too. But it's just a really important piece of your deal, knowing what the client's credit score is. So you have to, if they don't want to let you run their credit score, they're just not a real buyer, to be
Right.
honest. Like they need to be all in on this. And there's obviously certain circumstances where we can get around it, or I can pre-approve someone and just say, hey, I'll run your credit a little bit later. But I don't like that. It's not me doing my job right for you. It's not you doing your job right. It's not you value your time at all.
Right.
My opinion. So
Cool.
yeah.
All right. Thanks, Alex.
Thank you, Kelly.
Bye.
Yeah.
Thank you, Alex.
Finish your Zoom class.